look at all of this run here. Look at all this price delivery right there. Is there any inefficiency from this candle's high right here down to that low? Is there any inefficiencies in price? Small little one right here. This is the only inefficiency in this price run here. Started the run here, open, traded down. Whenever we see this is one of the things I teach. It's an immediate rebalance. That means it's as soon as it does that, you're going to see sudden price delivery, real quick. You tell me. Okay, does that look like it once it gets somewhere after it did an immediate rebalance? Of course it does. Where's it going to go to? That high. We can anticipate an entry here, a pyramid entry here, or if you missed this run, as I outlined live, that it's consolidating around that consequent encroachment of the higher time frame candlestick wick. That's what I was measuring on that. And it came down, hit it, rallied up just to take out the high. It did so here. No inefficiencies at all. And I want to see, personally, I want to see price stay above consequent encroachment. That'll tell me this is where we're going to run for at the 930. If we break down below it, then it's probably going to need to trade into this area here, which is of no consequence to me because I could care less. Now, another thing for your notes today, whenever there's two high impact news drivers in the same session, like we have an 8:30 news driver that just has already hit the market at 8:30, and then we have one at 10 o'clock. Whenever that happens, whenever that's in the economic calendar, my mind immediately goes to, in case you're wondering, like, why would I say 10 o'clock news should be used to go against everything that's going on? Think about it like this. If a terrorist was going to lay a bomb down, okay, and they do it this way. They go into a busy area where a marketplace or a storefront, and they set a small charge up. And when that charge goes off, what's going to happen? Everybody's going to run away from that point of impact, right? And they all run to a location where the larger bomb is, so that way there's more casualties, okay? In my mind, the way I internalize what they do is much like what I teach with FOMC, much like I teach with non-farm payroll. Those are financial bombs. Okay, they're literally placed in the marketplace. They're algorithmically delivered. And what happens is one news driver sends price, careening one direction. That's that first explosion. Okay, so at 8:30, what did price do down here? Running, right? We have a potential pool of liquidity up here where price could gravitate to, right? And I'm suggesting to you, as long as we're in the upper half, as long as we're in this area here, going into 930, I favor the idea that we could run up in here and sweep that out. And on some kind of momentum, overzealous price delivery, best case scenario would be up into this area here, this inefficiency on the higher time frame. But that 10 o'clock news driver and price running up to this level here and maybe spiking up beyond it to get into this inefficiency here, I would use, if I was making the market, I would use the 10 o'clock hour, that news, and the sentiment after seeing traders see it, rallying from 8:30, and at 10 o'clock, we see it going higher. What is the public going to do? What's the street money going to be thinking? Street money is going to be like, I want to be long, right? I want to be long. That's the very logic that I used on Wednesday to explain to you why we're trading where we're at right now through Thursday and now Friday's initial trading. Because I'm waiting for those wrestling matches when the sentiment of retail, the collective that is called retail trading, the street money, the quote unquote dumb money, and I don't mean that to be ignorant, but that's just what it is. I mean, I came from that too, right? Everybody is that when you first start. I'm waiting for the time period where what I'm anticipating that the algorithm will do, how it runs on specific narratives and its macros and the time of day it does certain things using the economic calendar, just like a TV guide. Okay, you can anticipate the sentiment shifts that the retail trader and collectively the traders will think and how they will perceive price before it even happens. So you're really not only predicting the future, but you're reading other people's minds in the future. And how would the losing crowd, the retail-minded trader, how would he fall victim to it? Because that's what this game's about. Every large fund manager is still a retail trader. They're literally trading with retail concepts. It's amazing. When you sit down and see what they're doing the same stuff that everybody has in these books. They're just doing it on a larger scale, on the higher time frame charts, and just allowing for more time to eventually move the market in their favor. That's all that's happening. Now, the proprietary firms out there that have their own algorithms that they're running in the marketplace that trade off of small short-term fluctuations in price action, they are not using retail logic. They're using a lot of the things that I'm talking about here today. The framework is around how they can get in, take bite-sized pieces. All right, so we have one candlestick down here that closed below it, and then we have this one here. I mentioned how it could draw down to that little tiny little inefficiency. It didn't touch it. I would have liked to have seen it hit that, actually, personally, but it's Friday, right? Some of you might see that as the model 2022, where it's a shift in market structure here, going up into a fair value gap, sell short, and then wait for it to keep going down lower. I would not take this trade using that logic, even if it does deliver and say it goes lower. I don't care about that because there's a 10 o'clock high impact news driver looming. It's Friday. The idea that it could squeeze up there even more, and why would that be advantageous? Because longer term, the market has been going where? Down. The last 2 months or so, or a month and a half, we've seen lower prices. So if we are, in fact, and let's play devil's advocate for a moment, just for the sake of this discussion, let's just say I'm right just this time, okay? And we do go lower, longer term. Say in November, we're lower than we went to on Wednesday of this week here. If that's the case, and say, for the sake of discussion, that I'm right, and it goes that lower price into November, and we go lower wherever, it would be advantageous for the market to go above these highs here because it would do what? Run buy stops. Why would that be advantageous? Because those buy stops could be used for what? Short entries for folks that want to do what? Build in positions that eventually will be underwater for longs, but profitable for them if we do take out Wednesday's low. So I use that idea and thought process coupled with the fact that we have two high impact news drivers in the same session. Whenever we have that, there's like this two-stage delivery. One's used to spur on a move or continue something that like we've seen since London. What has price done in London? 3 o'clock in here, we rallied, came back down in to inefficiency. Then we rallied again in between 7 o'clock and 8:30. News driver comes out 8:30. What is it used for? To continue what has already been in play since London. Okay, that means supercharge it higher. Wonderful, great. But we still have what? We have that 10 o'clock news. And it's Friday. So there's a lot of maybe you couldn't be right, but maybe you can be wrong. And I know that these are days that because it's two market drivers, I might not have the second at 10 o'clock pegged. They could use 10 o'clock to send it through even higher because it's Friday, because they want to squeeze up into all the trail buy stops, because that's where liquidity would be for someone to buy it from them at a higher price. Smart money, if I'm right, and we're going lower than Wednesday's low this week, if I'm accurate on that assessment, that belief, that opinion, and I'm not trying to make the case that I am right. I'm just submitting to the idea that what I do and how I'm reading price and how I use the economic calendar. And when there's two drivers in the same session, we're not talking about a high impact news event at 8:30 and then something at 2 o'clock. There's two of them in the same session, the morning session, the AM session. Because of that, my concern is that they used London to send it higher, which was in sympathy of what I outlined Thursday would be, which would be a retracement higher. 8:30, they send in more volatility and sends it higher. And now we have that looming 10 o'clock news. So I would not want to trade ahead of that because it can be utilized as I'm outlining here. I am completely content with being wrong. So if you're in this trade, okay, I'm saying trade, in quotes because I outline this as maybe some of you interpreting that as the model 2022, where um, we take buy side here, shift in market structure here. Here's the inefficiency. It's above equilibrium. So it would be in premium. Trading into this area here, you might look at that as a short. And I said I would not be interested in taking that because of the 10 o'clock news driver, because it's Friday, because it's rolling against the underlying sentiment that we've been bearish. So it's reasonable to anticipate them to want to take price up, to run those buy stops, allowing smart money to build in positions selling short. And they can sell early. They'll sell as the market's going up. They're selling into those rallies. Okay. Think about what we're seeing in the indices right now. We've already dropped a lot. It's perfectly reasonable for, as I was outlining on Wednesday, for the market to go higher Thursday and then Friday. And we've seen that happen. Why would that be advantageous? Because if the market can go up higher to knock out people that are profitable right now that trail their stop loss lower, their buy stop gets them out at whatever profit or loss that books at the time their stops are executed. The other side of that execution is a short seller, in my mind, that wants to establish a short position for the longer term. Let me ask you a question. If you would have took that short in this area here, would you feel comfortable with it right now? I don't see it that way right now. I think that they're going to use that 10 o'clock to run even higher for the purposes of sending it higher to sell short into, and in 2 weeks from now will be lower. That's how I'm trying to articulate the thought processes how I'm looking at price right now. Personally, if I would have used this pattern here to get short, it's highly unlikely I would have done it because these are too enticing. Or traders that are seeing this as a bull flag, they have their buy stops here to be buying long. They want to go long there. And if I'm accurate by what I'm suggesting, and if it does pan out, the shorts that have buy stops here for protective stop loss purpose only, if they run that, they get stopped out at a loss. The folks that use this idea here as a bull flag, they have a resting buy stop to enter long, to get long, to be net long. I think that at 10 o'clock or 9:30 into 10 o'clock, the run into this area may be higher. They will be in short-term unrealized profit that I think eventually would be cause a reason for them. Let's assume that, say, these two lows here stay intact and we don't go lower than that prior to 9:30. Okay. Or if we drop down there at 9:30, then I would anticipate price then reaching up here post 9:30. But assuming these stay the same, okay, and in 9:30 we run higher here, that trips in the retail traders that use a breakout strategy to go long. So their buy stop is their entry mechanism. That's their order to get in, not a protection behind a short position. It's an entry for a long position. They would be allowed to be in unrealized profit, but if they use the idea that I'm outlining here, and I might be wrong, it could just keep on going higher or never go up here at all. But in my mind, I'm thinking even if they get in, they'll have a short-lived objective. And if it starts ripping up to this level here, they're not going to want to get out because they think it's going to go to the moon. And then eventually at 10 o'clock news will come in, and then maybe there will be a sentiment shift that is used against them. And it starts raking them across the coals and goes down below these lows here, and they are no longer profitable. Consumption. Would you be comfortable with that short right now? Looking at the time, we're about 95 seconds from the opening bell. Would you feel comfortable in that short right now? With pools of liquidity here and here. I wouldn't be. This is also a time when I would not be in trying to early entry because sometimes you'll see me enter before or right at 9:30. This is one of those instances where I wouldn't do it. 30 seconds. And this is where you want to be at in the early stages of your development, where nothing can hurt you, nothing can cause any kind of pain. If you're right or wrong, it matters not. You're studying. You're looking at for the purposes of understanding the logic, understanding narrative. How does the market use the existing orders that are above and below the marketplace on the day and time with an economic counter like we have today? 9:30. Shorts are gone. Longs are net long. Told you it was not model 2022. Not bragging, but I'm just telling you there's a reason why when I pick trades to talk about or call levels beforehand, why I'm so accurate. I'm filtering out all of these types of scenarios. I'm filtering them out. I'm not going to fall victim to these types of things. So we've seen the short-term buy side taken here. Remember where the sell side is right here? And that little imbalance here and that small little volume imbalance, which I should have on the chart. Let's put that there real quick. I'll just highlight the low of it. So it can sweep below here, hit the small little fair value gap there, and that low of the volume imbalance right between these candles' bodies. It's the separation between, let me take this off. It's the separation between these two candlesticks' bodies. They can be linked with the wick or wicks, but the volume imbalance is the fact that there's no overlapping or touching of the two consecutive candles' bodies. See how it's whipsawing? Why is it doing that? Because you have a news driver that's the second one in the same session. 8:30, the news embargo lifts. That starts technically the morning session. Like you're in there watching what it can do based on the news drivers that come out at that time. Then you have another one at 10 o'clock. So we already had sentiment in the marketplace from London and from yesterday. It's been what? Short-term bullish. And then we had 8:30 news send it where? Higher, even still. Now we have the opening bell at 9:30. We've cleared the buy side. We've killed the shorts. Now, short sellers that want to sell in the breakout, they now have been engaged right here. This is where buy side is. Watch the consequent encroachment of the wick. We want to see it close above that. If it closes above that, we'll expect follow through. The reaction off of that fair value gap right there I mentioned, that in itself is a high frequency trade. This candle's low is 14,985.75. The low of that candle comes in at exactly at that price. The way you would use this one here is the same way I mentioned earlier. As it hit down here, it's taking sell side, these lows here, trading down to the fair value gap that I outlined real time beforehand, and then it stops right to the tick, turns around and runs consequent encroachment. It doesn't need to take this high out. Is there enough range in there to take 10 handles out? Yes. Is it something you should trade today? No. But it's something you can journal, you can observe it. But this is the stuff that you want to learn. This is the stuff that I wade through and I don't talk about on Twitter. We don't ever see these types of conditions when I'm chit-chatting and calling a specific move or a level. It's never in these conditions. Have you noticed that? Because that's the key takeaway this morning. Why am I so accurate? Because I don't talk about the times when it's like this, because it's what? It's much more difficult. It's 50-50, one way or the other. It could do either one of them. And you don't want to be in a situation like that risking real money. You want it to be so one-sided that it's obvious for you to expect it to behave a specific way. Now, if it was another day, not Friday, and we didn't have the 10 o'clock news, I would be selling short right there. As soon as it hit that low right there, I would have done it there. Looking for a run below here, first partial, and then I'd look to see if it could accelerate. I said if it were not Friday, if it was like Thursday or any other day, based on this and we didn't have the 10 o'clock news looming, I would trust that right there as an immediate rebalance and look for lower prices. Now, any day but Friday, without that looming 10 o'clock news, if I saw this price action right here, I would not be interested in holding the trade. The short that I would have used at the immediate rebalance there, I would kill it because it's already traded above equilibrium of the range. I don't want to see that because if it can trade that quick back to the middle part of it or equilibrium, then it can easily punch through, go to the other side. So in here, all this price action back and forth, the only thing I'm looking at, and I don't trust it, The only thing I'm seeing is that initial gap here, drawing that out in time. They keep using that. I don't trust that it wants to keep going lower because in my mind, this should have already went down below that low. It just feels like they're sending it lower to get people wanting to go lower. And every time they go lower, more people are going short. That just builds the buy side up here bigger. So this is like, in my mind, I see it as engineering more liquidity above the highs. We haven't had a trade today. That's good. But if you sat down your charts and you saw this right now, would you feel inspired to trade it? Don't look at it like this. Like if you saw it naked, no lines on the chart, would you feel like, oh yeah, I definitely want to trade that? You have to know where these problem areas are, where price will be absolutely manipulated. Ahead of FOMC, the market can consolidate before. Everybody knows that. Like everybody knows that, but it doesn't always do that. It doesn't always do that. But whenever there's two market drivers in the same session, I anticipate this type of whipsawing, fickle price action where it can trap you. And many times, what you think is there in the chart, the opposite's coming. The opposite's going to just spring out there, and you're like, man. And at 4 o'clock, it's going to all look obvious to you. The people that got short below here want to break below that, selling weakness. What do you think they're feeling right now? Remember, the run above here, the buy stops, were used for what? The bull flag traders. Their stop loss is going to be placed where? If they get filled on a break above here, their stop loss is going to be what? Below here. They got tagged. So far, nobody's profitable today. They keep banging both sides. Both sides. This is Seek and Destroy. For a profile sense, this is Seek and Destroy. And what's going to happen at 10 o'clock, the real run, the purges everybody, where the majority of the liquidity is, that's what's going to materialize. We're talking about narrative today. We're talking about avoiding problematic trading conditions. We're talking about days that have two economic drivers in the same session. How about them shorts? Teaching when not to trade. That's a novel idea, isn't it? But that's the lesson you need to learn. All right, so just a little bit less than 12 minutes to go before we have that 10 o'clock news event. I believe we're going to go above the blue line, and then once we do that, I would like to see it take out the low of, we'll just say here. Well, there you go. Thank you for giving it to me beforehand. Thank you. The shorts have been murdered. The longs on the breakout were not allowed to be profitable, and we're trading up into that shaded area I talked about this morning. Not quite yet. It'll be there. And hopefully you found something in all this insightful. Hopefully it allowed you to understand more about what you should be avoiding, even behind all the mess and the chop. If you understand what price is likely to do, how it books, how the algorithm actually delivers price, how it engages and uses sentiment and entices traders to do things from a sentiment basis. All those things are narrative, and it's not something in books. It's not something in other people's courses. You have to sit in front of the chart for a long time, months, years, and then you'll develop the skill set. Do you need to have this much detail in understanding price to be profitable? No, you can have a very simple model like I've already taught. But if you really want to be an ace and you want to know what you're doing and how to avoid the pitfalls of everybody else out there, and you want to find something that has absolutely unrivaled precision and sound logic, you found home.